Dive into the financial alchemy, unraveling the secrets of how banks create money and shape the heartbeat of economies. Welcome back, curious minds. Today we're diving into the fascinating world of finance to unravel the mystery behind a fundamental question. How do banks create money? It's a concept that might seem complex at first, but fear not, we're breaking it down into bite-sized, easily digestible pieces. By the end of this video, you'll have a clear understanding of the inner workings of banks and their role in shaping our economic landscape. So let's jump right in, money basics. Before we explore how banks create money, let's quickly refresh our memory on what money is. Money isn't just the cash in your wallet, it's a medium of exchange, a unit of account, and a store of value. In simpler terms, it's what we use to buy stuff, measure value, and save for the future. The mystery of banks. Now here's the million-dollar question. How do banks create money? The secret lies in a magical process known as fractional reserve banking. Let's break it down. Fractional reserve banking. Now let's take a closer look at the cornerstone of this monetary magic show, fractional reserve banking. When you deposit $100 into your bank account, the bank is only required to keep a fraction, let's say 10%, in reserve. This means they stash away $10 for safekeeping. But here's where the plot thickens. The remaining $90, that's the golden ticket. The bank can use this as the basis for creating more money through loans. It's like having your cake and eating it too, keeping a portion secure while using the rest to fuel economic growth. The magic of loans. Now enter the enchanting world of loans. The bank, armed with the power to create money, lends out that $90 to another eager customer. This borrower, let's call them Charlie, walks away with the $90 and starts making purchases. It's essential to grasp that this $90 didn't magically appear. It's part of the money creation process initiated by your initial deposit. Charlie's joyous spending is made possible because the bank has essentially injected new money into the economy through this loan. The domino effect. Picture this. Charlie spends that $90 and the person on the receiving end, let's call them Daisy, decides to deposit it into her bank account. Now Daisy's bank follows the same fractional reserve system, keeping 10% in reserve and lending out the rest. This domino effect continues, with each deposit setting off a chain reaction of loans and deposits, creating a ripple effect throughout the economy. It's a financial dance where every move amplifies the impact, showcasing the interconnected nature of our monetary system. Money multiplier effect. Let's delve into the intriguing concept of the money multiplier effect. As we've learned, the process of fractional reserve banking doesn't stop with the initial deposit. The money multiplier effect is the snowballing consequence that occurs as each bank in the chain of deposits and loans creates additional money. Picture it like a ripple on a pond. One small pebble creates waves that extend far beyond the point of impact. Similarly, the initial deposit sets off a series of lending and redepositing, expanding the overall money supply. The money multiplier effect showcases the interconnectedness of the financial system, illustrating how a single deposit can have a profound impact on the broader economy. It's a mechanism that magnifies the initial economic stimulus, amplifying the influence of each dollar deposited into the banking system. Limitations and regulations. Hold on a minute. Is there no end to this money creation madness? Well, not quite. Central banks, such as the Federal Reserve, step in to set reserve requirements. The percentage of deposits banks must keep in reserve. These requirements act as a check on excessive money creation, preventing banks from going overboard and destabilizing the financial system. Interest rates are another tool at the disposal of central banks, influencing borrowing and lending activities to manage the overall money supply. It's a delicate dance between fostering economic growth and preventing runaway inflation. By imposing limitations and regulations, central banks aim to maintain a healthy balance, ensuring the stability and resilience of the financial ecosystem. The interest factor. Now you might be wondering, what's in it for the banks? Well, let's talk about the interest factor. When banks lend money, they aren't just doing it out of the goodness of their hearts. They're in it for the interest. The interest on loans is essentially the price borrowers pay for the privilege of using someone else's money. So when the bank lends out that $90 to Charlie, they attach an interest rate. This interest becomes a crucial source of revenue for the bank. compensating them for the risk they take on by providing loans. It's a win-win. Borrowers get access to funds, and banks earn a tidy sum through interest. This interest-driven income is a significant component of a bank's profitability, ensuring they can keep the lights on and continue facilitating the creation of money through loans. Real-world example. Let's walk through a real-world example to solidify our understanding. Imagine a town with a single bank. Alice deposits $1,000, and the bank keeps 10% in reserve, $100, while lending out $900 to Bob. Bob then spends that $900, and the person receiving it deposits it back into the same bank. The bank now keeps 10% in reserve, $90, and lends out $810. This process repeats, and before you know it, the initial $1,000 deposit has led to the creation of several $1,000s in the economy. Impact on the economy. So, how does this money creation impact the economy? Well, it stimulates economic activity. When banks generate more money through loans, it's like injecting fuel into the economic engine. People and businesses now have more funds to spend and invest, stimulating economic activity. Job creation, business expansion, and improved living standards can result from this financial injection. The process becomes a catalyst for growth, fostering a dynamic and flourishing economy. It's the mechanism that propels us forward, driving progress and prosperity. The flip side. However, it's essential to acknowledge the flip side of this monetary coin. Too much money creation, like an overenthusiastic chef with the spice jar, can lead to inflation. Inflation occurs when there's too much money chasing too few goods, causing prices to rise. Striking the delicate balance between creating enough money to fuel growth without triggering runaway inflation is a constant challenge. Central banks play a critical role in managing this delicate equilibrium, using various tools to ensure a stable and healthy economy. It's a tightrope walk where the consequences of imbalance can have a profound impact on the purchasing power of your money and the overall economic well-being of a nation. And there you have it, folks, the mystery of how banks create money unveiled. We've journeyed through the intricacies of fractional reserve banking, the money multiplier effect, and the role of central banks. Now, armed with this knowledge, you can navigate the financial landscape with a clearer understanding of the forces that shape our economy. If you found this video enlightening, don't forget to hit that like button, subscribe for more financial insights, and share it with your fellow money enthusiasts. Until next time, stay curious.